We bring you our latest investigation into lending standards in the home mortgage industry. In an exclusive interview, a mortgage broker reveals the pressure he was under to write business in the lead up to the global financial crisis. The wash-up from that stampede into low-doc lending is still being felt amid signs that 7 years on, some lending standards are slipping again. Andrew Robertson reports.
Please don't stop the music.
It's early 2008.
Please don't stop the music.
The credit crunch has already started, but Lehman Brothers is still standing with the financial crisis yet to fully hit. The stock market is turbulent but still strong, the economy is booming, and banks are shoveling money out the door as fast as they can. Low-doc loans are the latest fashion, with brokers leading the charge.
Laura is incredible.
6 years on, it's such a sensitive issue, this broker would only agree to be interviewed if we concealed his identity.
In Australia, it was pretty much the same policy as it was overseas in America, which caused the subprime collapse, except not so serious, I guess, not so risky.
And according to this broker, the most aggressive lender was Macquarie Bank.
They went after pretty much the whole non-bank market, so they were letting other agents, what's called mortgage originators, brand Macquarie Home Loans as their own.
As always, from the broker side of the deal, commissions were driving the selling. Typically, what was a standard commission on, say, a loan from Macquarie?
You could get up to 1% commission if you had a big enough organisation, probably more.
So on a standard $500,000 loan, the broker would earn, say, $5,000.
Yeah, you'd be getting $5,000 plus trail commission.
So in a good month, what could a broker earn?
There's brokers out there that on a good month would earn $1,000, but there are also those who would earn 10 times, 20 times, 30 times that quite easily.
But behind the easy money and big commission payments, a trail of wreckage is coming to light, such as Sydney-based couple Brigitte and Antonio Furness, who were lent $1.2 million by St George Bank in 2008. They've now lost everything.
When you borrow money from somebody, it's up to them to check your credit credentials, whether you can pay that back.
Since we first introduced you to the Furnesses, the ABC has learnt the Financial Ombudsman Service has issued a damning report about their loans, implying that low-doc had virtually become no-doc. The Ombudsman accused St George Bank of maladministration in providing the loans. He says there were red flags in the Furnesses' loan application which should have alerted St George to make further inquiries. In particular, he refers to the Furnesses' ages, the bank's failure to independently verify their income, and unrealistic and unsustainable claims about returns on a share portfolio. Can you tell me about St George Bank?
One of the ways they tried to increase their market share was to cater for clientele the banks didn't cater for. And to do that, they relaxed their lending criteria quite a lot.
How did it work?
As long as you had some asset backing and met some fairly relaxed credit criteria and were able to get some boxes ticked, then you would sign a declaration form to say that you would not face any undue financial hardship and that the income that you wrote down on the application form was true and correct. And that was it. The loan was then approved.
Since the financial crisis, low-doc lending has plummeted from 11,000 loans a month to less than 2,000 a year. And although low-doc is now virtually off the lending agenda, for some who watch the industry closely, there are other worrying signs starting to re-emerge.
That some of the credit unions and some of the building societies and some of the regional banks have been growing faster as a relative to the majors than they have traditionally.
Martin North's research shows loan-to-income ratios are rising in Australia at a time when many other countries are capping them at sustainable levels. The proportion of home loans at 5 to 7 times income has dramatically increased and is dominated by battlers and young families. Surging demand for investment properties is also an issue, with lending now 50% higher than owner-occupied.
People are actually quite keen to be able to borrow as much as they possibly can to maximise the tax breaks. And that means that some of those loans will be high loan to value and will be for investment purposes. Now, those loans potentially could be more risky than your standard loans.
With $1.3 trillion in home loans, Australian lenders are heavily leveraged to the overheated property market, which means if the music stops through rising interest rates or falling house prices, the risk isn't just to individuals, but to the whole financial system.
Please don't stop the music.